Welcome back. This lesson is about introducing parabolic SAR.
I can't say that I've heard of this term before, so this lesson should be interesting.
Well, a parabolic SAR, which stands for stop and reverse, is an indicator that helps us identify trend endings and potential reversals. It's a lagging trend following indicator. It was developed by the mechanical engineer and technical analyst Wales Wilder. The term is often abbreviated to SAR for short. It's actually a trend following trading system which gives clear long and short instructions along with where the stop should be placed.
Interesting. Does that mean we can use it as a trading system?
It's got its weaknesses as a trading system that we'll look at in a minute. But even if it's not used for that purpose, it's useful just as a trend indicator. SAR works by plotting dots on a price chart. These are below the price when it's trending up and above the price when it's trending down.
So is this where the stop and reversal part comes in, when the trend changes?
Yes, the indicator stops and reverses when the price trend reverses and breaks above or below the indicator. It'll make a lot more sense when you see it on a chart. But first, let's go through the formula. So now we're going to look at how we can calculate a parabolic SAR. The formula is a bit like a swan.
Sorry, did you just say it's like a swan, as in the bird?
Yes. The formula is calm and fairly simple on the surface, but complicated and frantic under the water. I appreciate when we go through a formula like this, it can get complicated. Don't worry, you don't have to know the formula off by heart. There is a spreadsheet of the calculation we are going to go through in the material section.
Well, that's reassuring, I guess.
The reason that we look at the formula is to highlight the areas that will have an impact on us as traders. Any good charting package will have parabolic SAR and allow you to set the indicator variables. The indicator was originally designed to be calculated after a day's trading, calculating the next day's SAR. The data point is plotted on a chart and then fixed, unless it's breached off by the price.
Okay, that makes sense.
The complicated part is that SAR has a different formula depending on whether it's in an uptrend or a downtrend. We'll look at what makes it switch between the two in a moment, but for now just understand that the indicator only recognizes two trends, up or down.
Okay, I understand. So what's the formula?
Here it is.
It's not as bad as I thought. There are still a few terms in there that I haven't heard of before, though.
Don't worry, I'll explain each of these. Let's go through them one by one. The extreme point refers to the highest price reached during the current trend. This can be over as little as one period if the trend has just switched. There is no limit as to how long a trend can be, so there is no cap on the historical periods that the formula looks back at. However, during an uptrend, it's likely the extreme price has been in the last few periods.
Okay, I'm following. It wouldn't really be much of an uptrend if it wasn't.
The previous SAR is then taken away from the extreme point and multiplied by the acceleration factor.
And what's the acceleration factor?
The acceleration factor is also known as the step, which influences the SAR's rate of change. The two settings we can specify are the minimum step increment for a period and the total maximum step for the trend. If the new highs are recorded, the step must increase by the minimum increment we've specified up to the maximum. Wilder designed this to allow the indicator to accelerate towards a developing trend at rates set by the trader. This creates the parabolic curve effect the indicator is named after. The step has the effect of giving the trend time to develop when it's in its infancy. But when the trend matures and the step is at its maximum, it will give a reversal signal more quickly.
Okay, so what's next?
So next, when we know the acceleration factor, we've got all our inputs and we apply the formula to get our next period SAR. But there is one final twist.
Of course there is.
If we do the above calculation and get a next period SAR that's below either of the last two periods lows, then we use the lowest value for SAR.
Is this when it stops and reverses?
No, not quite, but it's probably getting close if SAR is being revised in this way. SAR switches trends when the price in a period hits that period SAR. In an uptrend, this means the price has fallen back and hit the SAR. When there is a trend switch, the formula effectively inverses and the acceleration factor resets and starts again to give the new trend time to develop.
Can you go through the formula for a downtrend?
It's a little bit repetitive and it's a long formula. So in the interests of expediency, I would encourage you to look at the spreadsheet if you want to look at the workings. It's just the opposite of an uptrend.
I'll definitely check that out.
Well, that was pretty heavy stuff and you've done really well to follow it. Let's look at how we'd add a SAR to a chart. It is a lot easier.
I'll take your word for it.
Okay, let's pull up a chart of the Wall Street 30, the alternative name given to the Dow Jones Industrial Average. To add Parabolic SAR to a chart, we select Studies, scroll down and then find the indicator. You should notice that the SAR's data points have appeared on the chart, above and below the price.
Yes, I see that.
Good. So Wall Street 30 is in a significant uptrend at the moment, and SAR is below the price data, confirming the trend. Look here, where a downward is starting to form. We can see that SAR switches and it's above the price.
Yes, I see that.
This is where having two formulas based on the trend plays out. The SAR results can change significantly when the trend switches. We can see during a trend how the indicator curves towards the price data. This is the parabolic nature of the acceleration factor calculation playing out.
Okay, I'm following.
And then you can see here, later in the trend, there is less room for the price to fall back compared to the start. Remember, SAR was designed as a trading system. It is designed to take the trader out of the market before the trend has time to fully reverse.
Yes, I remember that.
Now, let's take a look at what happens when we change the step variables we mentioned earlier. If I go here, I'm presented with the option of setting the minimum step change and maximum step, while the recommended using 0.02 as the minimum increment and 0.2 for the maximum. This is the default. Let's look what happens if I change the minimum step change to 0.01. It has reduced the sensitivity of the indicator and has resulted in fewer stops and reverses. Let's change that back to 0.02 to show you the change back. This is making SAR more sensitive. If I reduce the maximum step to 0.1, it will have no impact at the start of the trend. This is because it will take at least 5 periods for the 0.02 to hit the new maximum. Reducing the maximum step means that the SAR cannot close on the price later in the trend as fast as it did before.
Thanks for that demonstration. So, would I be right in saying that the less sensitive the indicator, the fewer reversals? But it might keep the trader in a price reversal longer, which means they could lose gains.
That's a pretty good summary. It's a balancing act, and for now I would recommend keeping the default step settings.
So how do we use Parabolic SAR as traders then? I'm guessing it's going to be pretty complicated.
Actually, although the formula is complicated, using SAR isn't.
Ah, that's like music to my ears.
It's a very commonly used tool, but over time its limitations have started to show. It's used as a trend confirmation tool, a trading signal, and most frequently as a risk management tool.
What do you mean when you say that its limitations have started to show?
Well, SAR is designed to be used in up or downtrending markets and over long-term timeframes. When a market is trending sideways, it's difficult to use and can generate multiple false signals.
Okay, I see. So it's a bit like the MACD. It doesn't work in sideways markets.
Yes, correct. In addition, time is not SAR's friend. The issue is when trends pause, it has tendency to take the trader out of a trade, only for the trend to gather energy and carry on. Okay, let's look at the indicator as a trend confirmation tool. It's actually a very easy way to determine the trend.
How so?
Well, it's binary in nature, completely objective and visually easy to read.
So it sounds like it's a lot easier to interpret than to calculate.
It certainly is. If the dots appear below a price, it indicates an uptrend and traders look for long setups. If the dots appear above a price, it indicates a downtrend and traders look for short setups.
That makes sense to me. Thanks for the explanation.
Now, let's look at SAR as a trade signal. Basically, some traders use it as a trading system in and of itself. It was designed to tell traders when to go long or short. As I said earlier, I wouldn't recommend pursuing this system because of the limitations above. We'll see later, at the end of the course, how you might start to combine SAR with other indicators to get the best out of it.
Sounds good.
Finally, let's look at the indicator as a risk management tool.
So this is the most popular way to use SAR then?
I'd say so, yes, because SAR calculates a value for the next period and can never be moved back against a trend. It's very useful for easily setting and then adjusting stop losses.
Okay, and the benefit would be to lock in profits?
Yes, if it's done consistently. SAR can lock in the profits gained from capturing a trend. It's one of the best systems for this.
I see. Thanks for explaining.
A parabolic SAR, which stands for stop and reverse, was originally designed as a trading system and adopted as an indicator by traders to help identify trends and potential reversals. Developed by Wallace Wilder, it's a lagging trend following indicator.
SAR has a complicated formula depending on whether the price is trending up or down. Initially intended to be calculated at the end of the day, the key variables set by traders are around the acceleration factor, also known as the step. The indicator's outputs are plotted on the price chart. If there's an uptrend, these are below the price, and vice versa for a downtrend.
We added a SAR on a chart and saw how the indicator curves towards the price in a trend. This is where it gets its parabolic name from. When we change the step variables, we're able to specify the minimum and maximum step change. This changes the sensitivity of the indicator.
Although the formula is complicated, using SAR isn't. It's used as a trend confirmation tool, a trading signal, and most commonly as a risk management tool.
The indicator can also be used as a risk management tool because SAR calculates a value for the next period and can never be moved back against a trend. It's very useful for setting and then adjusting stop losses.
It does have its limitations. SAR is best used in up or down trending markets and over longer term time frames. When a market is trending sideways, it's difficult to use and can generate multiple false signals. This is why it's not used much as a trading system nowadays.
SAR works well as a confirmation tool because it's binary in nature, completely objective and visually easy to interpret. If the dots appear below a price action, it indicates an uptrend and traders look for long setups. If the dots appear above a price action, it indicates a downtrend and traders look for short setups.
The indicator can also be used as a risk management tool because SAR calculates a value for the next period and can never be moved back against a trend. It's very useful for setting and then adjusting stop losses.
Excellent summary, guys. I'll see you all in the next lesson. I appreciate that calculation section got complicated, but it's good to really get into it. I would recommend reviewing the spreadsheet of the formula we've got in the materials section. Bye for now.